You followed your trading plan, locking in a setup that looked practically guaranteed. And then the market snaps shut right in your face. Look at this chart. We have a clear bullish trend, a pristine retest on a powerful support zone, and a perfect bounce right off the 0.382 Fibonacci retracement. Every textbook tells you to hit the buy button, so you enter the trade. You set your stop loss just below support, feeling entirely secure. 3 candles later, the price plunges straight through that floor, taking your money with it. But here is the part that actually hurts. The exact second you get stopped out, the chart violently reverses. It rockets straight up into your original profit target, leaving you empty-handed. If you post this on a forum, a dozen trading gurus will point it out after the fact and call it a liquidity sweep. But pointing out a trap after it has already triggered doesn't help you manage your risk in real time. Analyzing a chart once it is already finished is useless for generating profit. Professional trading requires using the existing market structure to identify where these traps are likely to form before you ever place an order. Let's look at this diagram showing where retail traders place their orders. Those glowing red clusters above resistance and below support represent thousands of retail stop losses. In the smart money concept, we call this liquidity. These clusters act like massive magnets for institutional algorithms. When the market hunts these stops, you get one of two outcomes. Scenario A is the liquidity sweep. The price dips just low enough to swallow that cluster of sell orders, fills the institutional positions, and immediately reverses course. Scenario B is the liquidity run. Here, the market hits the stop-loss cluster, but uses those orders as raw fuel to aggressively accelerate, blowing past the zone and continuing in that exact same direction. This creates a brutal guessing game in the live market. When you see a sudden spike heading straight for your stop-loss, you decide whether to brace for a continuing run or look for a reversal entry. Navigating these spikes requires moving beyond basic support and resistance lines to identify these specific structural zones where the market is actively searching for orders. We are taught that a bullish trend is a clean sequence of higher highs and higher lows, but this diagram shows the reality. If you zoom in on any smooth trend line, you will see a fractal zigzag of impulses and pullbacks. To understand the structure, we first identify the heavy anchors. These are the major swing highs and major swing lows that define the macro direction of the market. The massive clusters of stop losses sitting entirely outside these major swing points form our first category, external range liquidity. Now look at the movements trapped inside those major boundaries. The smaller stop-loss clusters hidden within these minor fluctuations represent our second category, internal range liquidity. Confusing a minor internal fluctuation for a major macro boundary is the specific mechanical error that causes almost every perfect setup to fail. This brings us to a specific predictive framework. First is the rule of the run. Look at this chart where a market is actively trending and the price action pushes outward to target that major external range liquidity boundary. When external liquidity is targeted in a trending market, you have a high probability of a liquidity run. The institutions are driving price past the major swing point to continue the trend. Next is the rule of the sweep. Look at this chart where a bullish trend takes a breath. The price pulls back downward, moving away from the external boundary to hunt the internal range liquidity sitting between the macro swings. As long as the macro swing low holds firm, targeting this internal zone indicates a liquidity sweep. The algorithms are pulling price back to grab internal orders before resuming the true upward trend. Identifying whether the market is targeting an internal or external range provides a clear indication of whether the price is likely to reverse or continue its current momentum. Let's go back to that failed trade from the beginning. We have the pristine support line and the Fibonacci bounce, frozen right before disaster strikes. So what actually went wrong? When we apply our internal and external framework, the error is obvious. That perfect support level wasn't a major structural anchor. It was an internal swing trapped inside a larger macro trend, making it a primary target for a sweep. By placing a stop loss inside an internal range, you unwittingly offered your order up to be filled by institutional algorithms. The market swept that internal liquidity to build position size before launching the next macro leg. You can adjust your strategy by waiting for the market to dip down and sweep that internal liquidity before entering. This allows you to step into the market alongside institutional momentum rather than becoming its target. By categorizing internal and external ranges, you can identify which areas of the chart the market is likely to respect and which it is likely to run through. If you're ready to master these technical concepts, check the description for our 30-day trading masterclass.